guys, my name is Ali and I am a lifelong investor. I have been buying stocks since 2002, real estate since 2010, option trading since 2015, and crypto trading since 2018. This video is part of a larger series on the US stock market. The overall course is about 30 to 50 hours. The course is designed to help you generate consistent cash flow on the US stock market to eventually help you obtain financial freedom for your future. Before we get started, a small disclosure. The material is distributed for general educational entertainment purposes only. The information is gathered from public and private sources that we believe to be reliable. However, no representation or warranty stated or implied is given to the accuracy of the information. And we disclaim any liability for the accuracy and completeness of the information. The opinions and views have not been tailored to the investment objectives of one individual and can change at any time without notice. We do not have any obligation to provide revised opinions based on any changes. All investments involve risk of loss 100% or more. Nothing contained herein should be construed as an investment advice. Any reference to past performance or potential performance is not and should not be construed as a recommendation or guarantee to any specific outcome. Any ideas or strategy discussed should not be undertaken by individual without prior consultation to a financial professional and/or advisor for the purpose of assessing whether the ideas, strategies are discussed are suitable for your own personal financial objectives, needs, and risk tolerance. Please consult your legal advisor, tax advisor, accountant advisor, investment advisor to speak to them about your specific risk tolerance. We expressly disclaim any liability or loss incurred by any individual. The information herein should not be considered as a recommendation to invest into the stock market, buy or sell any security or instrument. We will not buy or sell any investments or securities to you herein. This information is for educational and entertainment purposes only. About us, Omega Income Club is to empower investors to consistently generate positive cash flow week over week, month over month, year over year. Our belief is if we are able to generate consistent cash flow, we will be able to recover 100% of our investment over time. And if we reinvest it, we can take advantage of the power of compounding to exponentially increase our returns. Overall, I'm a seasoned investor that believes in empowering the do-it-yourself investor to engage more with your finances. I have been investing in stocks since 2002, real estate since 2010, options since 2015, and crypto since 2018. I have a degree in accounting and have specialized my career in financial services, working at and servicing various banks on Wall Street, specifically JP Morgan, Credit Suisse, and Goldman Sachs. Overall, this is the course topics that we will be going over, and there is another video on YouTube. Just subscribe to our channel, like, share, and comment, and you should be able to locate this video in our other sections. Okay. So overall, this specific today's session is on the stock market basics. So overall, what is the stock market? The stock market is a place for brokers and traders to meet to buy and sell instruments. So essentially, it's a place where individuals come together, so they can exactly what it is, right? It's a marketplace. So think of it as something like a shopping mall, for instance, right? Where there's someone there that is trying to sell the goods, and then another person that goes there to buy the goods. Okay. Within the stock market, there are multiple different instrument types, right? And these instruments, think of them as products in a mall, for instance. Okay. So different instrument types are stocks, ETFs, option futures, and then there's others as well. So overall, stocks are, they're equity, fractional ownership of a company, right? So think of it as, for instance, a company issued 100 stocks, you buy one, you are then the owner of a company. Here, you essentially have the option to go long or short. So if you go long on a stock, that means that you believe that the value of the stock is going to go up over time. Okay. And if you go short on a stock, you believe that the value of the stock is going to go down over time, right? So what happens is in a bull market, most of the individuals, they go long. And in a bear market, most of the individuals, they go short because you want to follow the trend of the market. and the trend of that specific stock. Okay. The second instrument that we're going to discuss today is called ETFs. So ETFs, it's a basket of securities, okay, or a basket of instruments. Um, Essentially, an ETF, which stands for electronic traded funds, um, it can be a combination of stocks, bonds, or cash, right? ETFs are used to diversify across multiple stocks. So for instance, you can buy an ETF that tracks the NASDAQ, something like the QQQ, or or you can buy an ETF on a specific commodity, such as DBC, right? So in, I guess, layman terms, right? If you were a business owner, right, buying a stock would be like saying that you are buying one business, right? So exactly that. You're buying one business. That's it. And what happens is all your risk is essentially tied to that business. So if that business, if you're long the stock, if that business ends up failing, then you lose 100% of your investment. Okay? An ETF is slightly different in a sense that because it is a basket of stocks, it is essentially a basket of businesses, right? So, for instance, I guess a great example is, Sears going bankrupt, right? So if you were an investor in Sears and you invested $1,000 when Sears went bankrupt, you essentially lost your entire $1,000, right? But if you invested into an ETF which held maybe Sears, Target, Macy's, Walmart, and various different retail consumer type stores that they were it was an ETF that was specifically for consumer retail, then when Sears goes bankrupt, right, you would not have lost 100% of your investment because the ETF itself would have some sort of diversification in it. So hypothetically, if all else stayed equal, if Sears it had the allocation of 3%, sorry, if the ETF had an allocation of 3% in the Sears, and if all else stayed equal, if Sears goes bankrupt, the value of the ETF would go down only 3%, versus if you had invested in Sears directly, you would lose 100% of your investment. Okay, so this is overall a very important topic and concept, and you'll see throughout the course um, why my go-to strategy is focused on investing primarily in ETFs. Okay, I look at it as a risk management tool that allows me a broad diversification into the industry, right? Sorry. Another example would be for the past 6 months or so, right, or 8 months, oil has been going up a lot, right? Commodity sector has been going up a lot. In the oil industry, we have, for instance, Citgo, ExxonMobil, Oxy, Marathon Oil. Um, if you're not too familiar with how to read an income statement or a balance sheet, and you're unsure, right, which is the best oil company to invest in, a great tool would be to maybe invest into the XLE. So XLE is the S&P 500 oil and energy ETF. By investing into that specific ETF, you get a diversified investment into multiple oil and energy companies. Therefore, you're reducing your risk if, per se, one of those companies was to go bankrupt for some reason. Okay. Another very important topic is options. Um, so options essentially are contracts that give traders the option, but not the obligation, to buy or sell an underlying asset at an agreed upon price or date. So options, they're overall, they can be very complex. There's literally 500-page textbooks on this topic. Um, but overall, the goal and idea is going to be to simplify it for you guys over the course and show you how options can be used to generate a consistent cash flow, right? And that's in combination with some of the other things that we're going to be going over, right? Um, so in an option, you can essentially buy a call, buy a put, sell a call, and sell a put. So there's four different combinations. Other parts of an option are the four Greeks, which we'll go in depth at a later point, as well as the intrinsic and extrinsic value. Okay. So these are all very important concepts that we'll be going over as we go into the course more and more, and you'll see why these are important. Okay. Um, Futures. So the next instrument type is futures. Futures are essentially contracts that allow traders to buy or sell an entire index or an entire commodity or an entire, even a sector sometimes, right? I highly recommend individuals not to trade futures. Futures are highly levered, highly margin investments, and they can cause significant pain. Okay. So as previously mentioned, disclosure, there's times where you can lose more than 100% of your original investment. Futures would be that instrument type if you want to risk losing more than 100% of your original investment. So, I highly recommend individuals to stay away from it. However, for our course and our training program, futures, the data that we get from it is extremely important. And I personally utilize the data from futures on a daily basis in order for me to then pick and choose the ETF and the option that I'm going to be trading for that day, for that week, month, quarter, essentially, whatever my time horizon for that specific trade is. Okay. Um, Other instrument types that are available are, mutual funds, bonds, and certain other types. Tips, for instance, right? Um, I don't really mess around with these too much. They're not really my specialty. They're not really my forte. But there are other investment types out there. Just brief overview. Mutual funds are something very similar to an ETF. However, one slight difference between a mutual fund is that when you enter an order, the price of the mutual fund, it's based as of 4 p.m., as of the market close. So if I enter the order at 11 a.m., the order is not going to get executed until the end of day, until 4 p.m. Okay? And the reason for that is that mutual funds, they have something that is a NAV adjustment on a daily basis based on the underlying holdings, the combination of the stocks and bonds and cash that they're currently holding, right? ETFs are, better in that sense that if I want to buy it based on the price I see at 11 o'clock, I can do that, and I can immediately sell it at 12 o'clock. With mutual funds, you cannot do that. Um, Most mutual funds carry a 30-day, sometimes 60 days, sometimes even longer holding period. That means that when you buy the mutual fund today, you have to sit on it for at least 30 days, 60 days, 90 days. Sometimes if you exit out of the mutual fund, you cannot buy it back for X amount of holding period. So there's a lot of different restrictions, and that's why me personally, I don't really use them or trade them. Another instrument type is bonds. So, bonds is, I'm sure a lot of people are familiar with this, but just to kind of give a brief overview, Bonds essentially is, lending money to a, an entity, right? Whether it's a government entity, a a company, um, and the entity at the end, they're saying it's a more or less a promissory note where they're agreeing to give you, a set interest rate based on a specific date. Um, Again, bonds is something that I don't really trade. I don't really invest in. It was something I did a couple of years ago, more for tax purposes. But it's something that, you know, uh, personally, I think for myself and the experience that I have, um, the return on bonds is very low comparative to what I'm able to get, using my custom strategies. Okay. Um, Another thing that's very important is different account types. So one of the account types is a cash account. A cash is a typical account type. So for instance, if you're buying a company, if the share price of the company is $10 and you want to buy 100 shares, that means you must have 10. Sorry, you must have $1,000, right? So 100 times 10 is $1,000. You must have that in your account before you can execute the trade and buy the security. Okay, so that would be a cash account. The second type of account is a margin account. Um, Margin account essentially it allows you to leverage to buy greater than the cash available. So for each security, there is something that's called a margin requirement. You will see that in the details, and we're going to cover this topic more when we start diving into different samples and actually sharing other resources throughout the course. But essentially, each security has a specific margin requirement. So, say hypothetically, the same $10 stock, right, that we just talked about, if that stock has a margin requirement of 50%, right, in a cash account, you need the entire $1,000 to buy. But in a margin account, you only need $500 to buy. Okay. And essentially, what that does is allows you to buy more than the cash you have available. This opens up you know, uh, uh, another set of, I guess, things that come up. Um, Specifically, when your broker is lending you the money to buy that share. So that $500, it's not just coming out of thin air, right? The broker is essentially lending you the $500 in order for you to go buy that share for 500 instead of 1,000. And in exchange, the broker is charging you an interest rate. So it's extremely important to, in my opinion, not use margin, right? And if you are using margin, make sure you're using it at a time where you have a, you know, um, very low risk, very low risk, very high probability that your trade will be successful. And at the same time, the return on the trade should be greater than the interest rate the broker is charging you. Okay. So if the broker is charging you, say 10% for the year, right? That comes out to be approximately, zero point 0.8, 0.75% ish for the month, right? That means that if, you're using margin, you want to make sure that you are going to generate more than that percentage on a monthly basis, right? To then be able to pay the broker on the interest and still generate a profit for yourself. Um, I personally try to stay away from margin as much as possible. I'm not a big fan of overextending my needs or overextending my investments, and it can become very dangerous, right? So, in the same example above, if the margin requirement on that stock is 50%, and if it's a $10 stock, and you put in $500 to buy $1,000 worth of shares, if the value of the stock drops to say $2, so from 10 to 2, and that does happen in the stock market world, right? Where the value of the stock can drop 80%. Um, at that point in time, your broker is going to do one of two things. One, they're going to contact you and they're going to tell you, hey, there's a margin requirement and you need to put up the additional money, right? Because now you essentially lost their money and they're going to want their money. So they're going to contact you and say, hey, you need to put up the difference on the margin requirement because the value of the stock has dropped significantly. And if you do not deposit that money within the time frame that they have given you, they will essentially liquidate your position. They will force the position to be sold at that $2 price, even though you bought it at 10. So, it's very important to understand that concept, and it's very important to understand your own investment limitations, your own investment your investment tolerance, your additional cash flow, your additional cash that you or investable cash that you do have available. So, if and when, if you come across this, that you are able to put up the margin if needed. Okay. So overall, that's all I have for today on the stock market basics. So please, subscribe, like, comment, share, so you get future updates, and to overall give you a preview of what's going to happen next. Um, so the next topic we're going to go over is the Thinkorswim platform. Thinkorswim is, it's an application that is by TD Ameritrade. They're the owner of this application. It's my favorite application to trade on the U.S. stock market. And essentially, we'll be going over, various topics in here, such as screen customization, building scanners, building alerts, building studies, um, how to enter a trade, how to use the Theo calculator, and just lots and lots of different topics, on this platform. I have been using this platform for uh, 3, 4, 5, at least years plus. I mean, it's been a very, very long time. Definitely my favorite. And then other topics, excuse me. And additional topics we'll be going over the next, couple of weeks are going to be technical analysis, and we'll go into the details of that as well. So please, once again, subscribe, like, comment, share, so you get notification on the updates on the videos, and your friends and family can also benefit from all this free content that I'm going to be putting out there. Thank you so much for your time, and enjoy your day.